Jeff, welcome to the show.
Thanks, Meb. Glad to be here.
Good to see you, man. Where do we find you today? Chi-town?
Yeah, that's where right here, where all the magic happens, right here.
Um,
For many, many years now.
I need to get back. You know, Chicago, one of the stops on the investment world circuit for sure. One of my favorite places, and this time of year especially is pretty awesome. So hopefully, fingers crossed, soon this summer. You gonna be around?
Well, generally, I mean, with this, this new post-COVID world, I mean, you could do this. You don't have to necessarily go down to the loop to hold down a traditional laptop or computer job. So we're in and out of town, but we try to stay here. I mean, it's the best 2 or 3 months of the year. It's
Yeah.
frozen tundra, so you catch June or July here. It's like
Well,
electric.
I grew up partially Colorado, and the coldest day of my life, I think, was downtown Chicago once as a youngster. All right, well,
I believe it.
you are one of my all-time favorite Twitter followers, and not because
Okay.
you get in fights with Elon or and just post memes all day, but you really have some great charts that you post on a consistent basis, and for a visual learner like myself, I love it. And not just
Thanks,
because
man.
I agree with all of them, because sometimes I don't, but I think you put out great work. So where should we begin? You've talked on a couple topics the past year or so that I certainly tried to amplify because I thought not many other people were talking about them, and we'll get into some of those, but
Okay.
I'll let you choose where to begin today. I almost feel like we kind of got to start with inflation, but what do you think? Where should we begin?
Oh man. Well, first off, thanks for saying the nice things about the content over there on social media. Hey, look, if you want to start with inflation, there's no shortage of opinions here. It's certainly tied in with everything that's going on in the new prognostication of this market is whether or not we're slipping into recession. I think that will soon take the number one rank here in market priorities. Inflation just totally dominated for what would you say, the last 9 or 12 months?
Which is funny
Um,
because for the prior, I don't know, 20 years, 30 years, it was not something that people really talked about, at least not in the United States. Talk about it elsewhere. Talk about it in Argentina and other places in the world, but not in the US.
yeah, other than at the beginning of my career, oh, 06, '07, the oil price was zooming and people were getting pinched at the gas pump, and we had housing tumbling, and we were ready to get Bear Stearns to buckle those hedge funds, and Bear Stearns itself, back there in March of '08. That was really the only time we had a little flirtation with inflation before this. I mean, this has been out of the ballpark.
Yeah. So you got two camps, and it's interesting because it seems like there is a very wide spread of opinions on potential outcome of inflation. I talk a lot. I joke about kind of coincident indicators in Los Angeles, which is probably the brunt of it, with $7 gas,
Hmm.
potentially $8 gas, $40 hamburgers, that sort of stuff. But
Right.
you have we had a guest, Peter Zion, who's a geopolitical strategist, and he had some sort of quote today when he said, so he's on one end, he says, this is the lowest inflation we're going to see in the US for the next 5 years.
Oh,
So
wow.
you
Okay.
get his perspective. Then other people are like, no, dude, we're going back to 2%. Where do you fall? What do you think? Somewhere in the middle? One of the
Uh, let,
extremes?
let me tell you this. I feel like I was pretty lonely during COVID, saying, look, we're going to have the price of Cheerios. At the time, I said the price of Cheerios we're gonna wake up, they're gonna be $6 a box. And I went over to the supermarket this weekend and it was $7 a box for Cheerios. Um, and I've been putting out these charts, and the UN Food Price Index has, in real terms, this is in real terms, Meb, has already exceeded the levels that you saw in '08 and '11. And the critical thing about 2008, 2011 is we had food price riots.
Major
In
geopolitical unrest, Arab Spring sort
That's
of stuff.
right. That's right. The Arab Spring was 2011. And look, it's not just food, right? Muammar Gaddafi, there was a target on his head to begin with. But certainly 2011 was a year in which food prices were rising precipitously and people come out in the streets. And one of the things about that is I hypothesize that will be the case this summer, and you don't know where. You started to see it in places like Sri Lanka. We have some comeuppances in some Latin American politics of late, right? It's just, you never know whether or not some radical will get elected in some of these countries just because the economy becomes so sclerotic. But at this point, we've blown out those old food price peaks of '08 and 11. And so you wonder, if you recall, the French yellow vest movement over
Mhm.
gasoline prices and diesel, which was what, 3 or 4 years ago. And those are always in places like Paris, these are always so much more benign than what you have in the global South, where you can really topple a dictator on account of these things. So this is one of those things that I think could be a market focus this summer. Certainly some sort of unrest. I don't know. Maybe it's in a place like El Salvador. What with the Bitcoin causing credit issues
Well,
in
yeah, I mean,
that
it's certainly
country.
it's often it's certainly I feel like with the food and famine and sort of things, there's often like you mentioned, like a little bit of a delay, and whether that's delay a few months or six
Hmm.
months, but as the kind of supply chains get all jacked up and as prices
Yeah.
start to impact, you know, this summer could be that time zone. I hope not, certainly. I mean,
Yeah.
would love not to see that, but you have to be prepared for, the reality of the potential outcomes. And
Hmm.
so all right, keep going.
Well, what the next thought that's been going through my mind for the last 45 to 60 days, and I'm the first one to come after these guys for what they did with QE and zero interest rate policy for way too long. If we're even supposed to have a central bank manipulating the cost of money, then if so, then they waited way too long. However, there are some indicators here that I think that 8.5 we saw on CPI 2 prints ago was the peak. 8.2 being the most recent. And if you just look at the data, and it's tough, Mab. I mean, because you can fall in love with your thesis, right? And some of us are predisposed to perma inflation or perma deflation because of our politics or our preconceived notions, or the even the way we were raised, right? If you're raised by someone who was saying, let me tell you about the inflation of the 1970s. I was brought up like that. Oh man, we had gasoline lines. You'll see there's inflation right around the corner, and you hear it for so many years, you start thinking, maybe I'm a perma inflation guy, right? And you start to look at this data, because I mean, I'm just dealing with this data all day long. There's a lot of things that are coming off the boil right now, right? You got the Harpex shipping index that peaked, right? That was the whole thing. Was it money supply expansion? Was it the supply chain? Was it people not going back to work because they were afraid of COVID? Maybe it was all those things. But now some of those things are resolving themselves, right? You got the shipping is coming down. You have the theory in my mind that home prices, what's the cure for high home prices? Like the cure for high commodity prices, it's that they come back down. I can make an argument here, a compelling argument, I believe, that home prices come down. I mean, what else you have uh, NFIB surveys, for example, in which a an overwhelming majority of small business owners saying, well, I think my sales are going to decline. I anticipate in the next 6 months my sales will decline. Well, that's a deflationary portent. Now, does that mean you have deflation, or you just have a lower rate of inflation? Because now I think that there's a lot of Johnny come latelys on this inflation thesis, and they're kind of missing the data here, which is that recession probabilities have spiked. They haven't risen, they've spiked. And to the extent that they have spiked, I think, notably in the last 30, 60, 90 days, generally speaking, that is something that reduces price pressure. Um, do we get down to 1 or 2 on inflation? I don't know, but I think there's a real chance that the 8 handle that we have on CPI could quickly get down to something like 3 or 4 pretty quickly.
Yeah, the and 3 to 4, I mean, that's in these sort of I like to call it, manageable range. Historically
Hmm.
speaking, I don't know if it's a mental thing, but for me, it seems 4 is like an inflection point, and above 6
Hmm.
is like the scary,
Yeah.
but certainly below 4. I remember there being State Street bottom, but a fun economics project many years ago called Price Stats, where they would track prices online in real time, as a complement to how inflation was working all over the world, and they track it in like 20 countries or something, and they had some fun updates.
Hmm.
But I think they were of your philosophy or camp, where that by the end of the year or a year from now, we would hopefully be back down to sort of meaningful levels. So it'll
Hmm.
be fun to watch. We're gonna have you back on in a year. We'll see where we are. See if we're talking about $60 hamburgers and $10
Oh,
gas, or $2 and In-N-Out $5. We'll see.
I know.
Um,
And there's so many moving parts too.
yeah. And part of it, like how much of it, as you think about with the financial markets and financialization of markets, as they have started to come down,
Hmm.
acts as a sort of anchor or downward pressure on inflation. Is that something we could count on? Is that unlikely? Like how do you think about that?
Absolutely.
Yeah.
I mean, just think about, like in econo speak, like marginal propensity to do something, right? So up and down the spectrum, if you were to just generalize, right? Picture in the young cohort, that's the crypto bro, right? The
Mhm.
25-year-old crypto bro, and he's been clocked. He has lost his money,
Yeah.
um, maybe all of it. Uh, does that guy go out and get a steak dinner on Saturday night? Now he was driving around in a Ferrari. Okay, and then you have the quintessential stereotypical retiree with the bond portfolio. Well, they got clocked too. The bond market is having one of the worst years on record, right? Um, and so you think about a baby boomer reining in spending, maybe not uh, buying that second home in Florida or whatever the case may be. This is all pullback on account of wealth effect. And then, of course, you have the stock market, which is somebody like me, the person who's in between the retiree and the 25-year-old, right? Overwhelming majority of the holdings of a 40 or 50-year-old would be in the stock market. Our society at this point, I could go down a whole thing about how maybe we should go this route, about how a typical 40 or 50-year-old who's not in this business is so in tune with the market compared to where they were a quarter century ago because of the existence of a 401k, right? And I've talked about this at length. I mean, I was doing this with the yield curve. I mean, can you imagine? Imagine there's such a thing as a podcast and the year is 1980 or 1990, and you and I start talking yield curve. And you got people on the phone that are not in Wall Street. They're intelligent people. They listen to finance podcasts, if such a thing exists in the year 1980, which it doesn't. And they're intelligent people. They're a dentist, a lawyer, whatever the case may be. Do you think they have any clue what a yield curve is?
Mm.
But now, I've said this. I mean, I think about, I'm 41. I go back to all these guys I went to high school with, 41 years old. They're not in financial services. They're across industries, smart people, right? They're professionals. They've got families, whatever the case may be. They all know what the yield curve is. Well, why is that? Because we have a 401k in our system. People have information at their fingertips and they hop on Yahoo Finance or CNBC when they're doing their morning coffee and they get their information. And so we are hyper aware as a society when it comes to, all right, Mab, or should you and your wife take a vacation? The classic COVID reopening positioning, right? You were supposed to get past COVID and then you were supposed to take a vacation. And on that vacation, you're supposed to hail an Uber and a Lyft.
Mhm.
You're going to work from home on that vacation via Zoom. I mean, this was everything that was working in 2020 and 2021. And if you're not even in this industry, you are well aware that the NASDAQ is down and crypto is down and the bond market is down because you're just a guy who's interested in markets on account of you're literate. And so I wonder on the wealth effect in 2022 compared to 1980 or 1990 or something like that, whether or not you have people say, oh, you know, we were going to take like a 7-day trip. Maybe we'll make it a 4-day trip. And maybe we won't make the trip at all. And so I think there is that feedback effect. And I worry about the health of the consumer here and some of these classic consumer spending patterns. And you can see it in the market's internals where discretionary, the action in discretionary is like a big red flag on this economy. It's that the market is barking and it's telling you a recession is a high probability.
Expand on that. You said, unpack that a little more. Keep going.
Oh, there's plenty to unpack. As the years go on, I've increasingly looked to the market itself for my cues. Now I'm looking at PMI, I'm looking at NAHB, home builder sentiment, that type of stuff. But look at the market itself. And what you have here is a complete deterioration in the market's internals, a massive rotation into defensives, toothpaste and tobacco, that type of thing. And the order of magnitude with which consumer staples in the last 6-7 months. I'm just cherry picking in my mind. That's my best guess because that's when the NASDAQ peaked, was November 19th of 21. The order of magnitude that Staples has crushed discretionary, classic pair trade, right? If you're bullish on the middle class, you should be getting long discretionary. And if you're bearish or defensive or concerned, you should be long Staples. And that's how you would over or underweight. And that's classic. That is part of the value versus growth trade too. Staples is loaded up in value, discretionary is loaded up in growth, and that's a big chunk of why value is beating growth this year. Notwithstanding the differentials between the financial sector and the tech sector between those two also. And when you look at the super spikes in a chart like like discretionary versus Staples or Staples versus discretionary, just directionality one way or the other, we don't have much precedent for the boldness of this move. Morgan Housel was out there on Twitter saying something that I think is important, and it's classic Twitter, which is you're trying to get retweets. You're trying to call for either hyperinflation or massive deflation, right? This is what these people do. And then Morgan Housel said, well, what if it's just like a minor recession, like a down the road? And that would be the Gulf War recession. 1990, 1991, where it's not debilitating like Lehman. All right, well, nonetheless, discretionary relative to Staples, Staples crushing it by thousands and thousands of basis points in the last 6 to 12 months. That's akin to something you've seen in the Gulf War recession, the Lehman recession, and the COVID move. So what's important here, I think, and this is, to me, you're always just trying to figure out where's my mind in terms of optimism or pessimism on important metric A or important metric B relative to street consensus. And we've gotten, fortunately for the bulls, we've gotten to a point where there is some things washed out, right? I mean, obviously you're down 80 or 90% on your Snap and your Zoom and your, what were we looking at earlier today? Zillow. Zillow just, it's like it looks like Mount Everest from the bottom to the top to the bottom. And so there's been obviously a lot excesses. The idiots from the Reddit message boards have been washed out with all of that. But my concern is, what this market action is telling us is the next thing to drop, if not with housing, maybe or housing, it would be the labor market. And that one is not a lot of people are talking about the labor market having a comeuppance here, and I'm increasingly concerned about it.
Man, you hit on a few different things that I thought were important. There's a good similar quote from Ned Davis where he talks about markets, but he's talking about price movements, and he's like, price is unique in that it's the only indicator that can't diverge from itself. You know,
Mm-hmm.
you can have valuation of stock market, values
Yeah.
continue going up, but he's like, price tells a story, whether you want to believe it or not. And a lot of
Mm-hmm.
the moves that we have may end up, telling that story in hindsight. On part of the, what's happened over the past year or two, as this trade has played out, and it's a sort of a similar market, regime. Bonds up, bond yields up, inflation and
Mm-hmm.
expectations up. A lot of the growthier stuff you mentioned, yeah, peaked over a year and a half ago.
Yeah.
Many of those names are down 60, 80, 90. And a lot of other stuff is rebounded. You have a great chart, FAANG versus FAANG. You want to tell us what that is?
You got the classic FANGs that everybody knows, right? Facebook, Alphabet, Apple, Netflix, and Google. And of course, they've all summarily changed their name. And so FANG doesn't even apply.
Yeah.
The time to ring the bell on Facebook was once they had to trot out that ridiculous meta on them and the stock's down 50 or 60. Once you change your stock, your equity name, run for the hills.
Yeah.
And of course, Google had to change it to Alphabet. It's just like such hubris to do these things with your stock. And then I went through and I said, look, here's this other group of FANGs. It's like some bank, First National Bank or something like that. And I know I put one of them was a defense contract.
First Energy, Altria, American Electric, Newmont, and General Mills.
Oh, Newmont, right? Newmont being the either the world's #1 or #2 gold miner, and
Yeah.
First
Yeah.
Energy, and what did we say? It was Anglo American. What was it?
Uh, First Energy, Altria, American
Altria,
Electric Power.
right? Altria being again that's the tobacco with Altria holding up on account of it's been that type of thing where the necessities or the things that you would purchase through a recession continue to hold up strongly at the expense of the darlings of the prior bull market, and that is something that I think is very, very important. And you have these market rules of thumb that some people would mention. Jesse Livermore would mention it 100 years ago, and it's not easy. Sometimes I'll give you an example. I mean, you had the bull market, right? It starts in March of '09. And these notions are you have leaders in a bull market. And then once a bear market arrives and a new bull market comes thereafter, you are supposed to have different leaders. Okay, so you have a bull market that starts in March 9th, 2009. And then let's say that it ended, February 19th of 2020 with COVID. And then you have a 6-week bear market to March 23rd of 2020. That is a bear market. There is supposed to be a new group of leaders that come out of that, but it wasn't such. I don't know. I mean, it's a 6-week bear market. Maybe it was so quick, nobody even had any time to think about it. Everybody's worried about COVID because it's the first quarter of 2020 back at the time. And you come out of that, it's boom, it's still Facebook. And it's still Amazon, although you started to notice some weakness in that stuff in 2021, like almost like it was trying to get the last gasps of perpetuating the '09 to 2020 bull market and make it push into 2021. And then next thing you know, you pull up some of the charts on some of those on a 2-year. Amazon comes to my mind immediately. That one's been dead money for I don't know. I'm looking at you. You're looking at a computer. 18
Mm-hmm.
months. Amazon's been dead. And then, of course, now rolling over. It was sideways choppy action for a while in this stuff. But, when you think about big, massive, memorable situations like 73, 74, and the Nifty 50 got taken out, right? That was the 50 stocks you're supposed to own forever. And you come out of that and you're in the mid 1970s and you really shouldn't be engaging the Nifty 50 per se. Although Jeremy Siegel over at the shop says if you had bought the Nifty 50 there, you would have been okay if you held it for 15 or 20 years. But, you think about the end of the
hold it. You just got to hold it for a lifetime. 15, 20 years. Come on, Jeff. You kidding me with this audience? Who holds stocks or investments that long? Nobody.
Well, I know. And that's one of the issues with the reality that we're all human beings and we have bills to pay and we have emotions and we have um, our own history. We have our own belief systems as to how intelligent we are relative to the public. And I actually don't even think super high intelligence is what you want. I think you just need above average intelligence to be good in the market because you have to have a feel for the way people think and what they're going through and the decision making process that people have. Because I think going back to that stuff we were talking about with COVID reopening, and maybe you don't take the 7-day vacation or something. You have to try to think about like how would a normal person think. You don't want to have like 160 IQ. I don't think.
Yeah.
Maybe you can't identify with it. So who knows? But here's the thing, man. You ended a major infamous bull market in March of 2000. And when it was time for a new bull market to commence in October of '02, it was a completely different basket. I mean, diametrically opposed, right? It at the end of that bull market, the 1995 to 2000 window was all large cap growth. Of course, they're large cap because they were just bid up so high. But one of the things about that 1990s market was we, in retrospect, think of it as only .com, but there was a lot of stuff really zooming back then, like Pfizer and Coca-Cola.
Yeah, no, I just did a chat with a biotech hedge fund manager where, I was reminiscing about the late 90s bubble because as a biotech engineering student, I was heavy in that space. And
Mhm,
it was very much a biotech bubble too, because if you remember, and that's, under the umbrella of tech, but it was internet names, but
mhm,
biotech, the sequencing of the genome was going on in that period. And so that was um, as much craziness. And I think, they did
mhm.
it, and the narrative is in retrospect, but I remember this clearly because I was in Jamaica on spring break, and Bill Clinton made some statement about at a speech about not patenting the genome, which started sending those stocks down. But it's like you find over the past, 6 months or a year in tech here, and biotech too. I mean, I think biotech's down by like a third or 40%, 50% this year
It's a
already.
lot.
You just you just look for the excuse or look for the narrative after the fact, right? Is like a lot of these
Mhm.
companies and stocks were had these massive run up, or a lot of the speculative excess, and then after it turns, it's you find the reason afterwards. And back then it was Bill
Right.
Clinton, and today it's who knows, something else.
Well, it's very important because I mean, I basically field this every day of my career. Are we being fair to compare what just happened to .com? What's it? And it's one of these things where it's like, well, do you need a bull market to be as bold as the most legendary mania of the last 500 years for things to be stretched? And additionally, even if we do think about .com, and you just step away from .com itself. I remember I did a tweet storm on this like a year ago. Okay, Micros Microsoft was a legitimate business back then. It's not like Microsoft was some fly by night operation. Microsoft doubled earnings every year from like 95 to 2000. That was a legitimate operation. Was it 2000 when General Electric was the largest corporation in the world? General Electric was no .com. That was a multinational conglomerate, which we later sometimes in these bull markets you get the conglomeration.
Right. One of the narratives you hear a lot these days is about the people, well, not now, you heard it last year, people justifying a lot of the valuations of the tech stocks of last year. And they said
Hmm.
it's different this time. It's different because these companies have real revenue,
Hmm.
unlike the stocks in 2000, which were companies based on eyeballs. And you've heard a lot of famous money managers talk about this. And it's funny because I
Hmm.
ran just exactly what you were talking about. I was like, look at the top 10 market cap companies in 2000, or December 31st, 1999. And they had tens to hundreds of billions of revenue, right? Like
Hmm.
these were not what they thought they were. And so, and then many of them, the stocks went nowhere for 10, 20 years. And some are still below, some are above. Microsoft took a while.
Yeah.
But people made that faulty assumption. And then, well, you know, here we are a year later,
Yeah.
but you don't hear
Yeah.
that analogy as much anymore.
I mean, I'd have to go back through. I remember I went right down the list. I mean, I'm just thinking about the names that were, I mean, Lucent at the time. Well, that was a
That gives me
legitimate
PTSD. I can't talk about that one. You have to keep going. I was a Lucent owner and would come home
Cisco.
every day. I would come home every day and look in the actual newspaper, and it was like
Yeah.
fractions at that time. It'd be like, it's up another $2 today, and every day, just like one after another. Uh,
Right.
that was CMGI, was another
Wait.
MEB ownership. I was the Robin Hood, except for me, it was E-Trade. So I see myself very much in a lot of, you know, the investors of the past couple of years.
You're taking me in the time machine, and I was in high school during that bubble, and I had the way I got interested in all of this was when I was in like second or third grade. That was that Gulf War recession, and they had a national stock picking contest. And I remember my old man's like a weekend warrior, right? Like guy gets barons and stuff like that. I'm like, Dad, how do I win this contest? It's like short biotech. Because nobody else, none of these third graders are going to know how to short anything. They don't know what shorting is. So if this market tanks, you'll win. And I think we got second in the whole.
That's
So I've been
funny.
like, so I was hooked for life, right? I was
Yeah.
addicted to it, and I remember, and this is important, I think. And if you can get yourself into a 1997 or 1998 consciousness, which is difficult to do now, where it's like we have Zoom, we're Zooming right now. I've got a computer here in my pocket, right? And I'm now going back to like my dial-up high school. Did I even have an email address in
Mm-hmm.
97, 98? Now, this is important because there were companies, I'm thinking eBay right now, that I thought, and I was not alone. This is like just the thinking of a 17-year-old back then, that eBay was going to take over the world. You remember feeling that way? I mean, that every mom and pop was going to ultimately sell via eBay, and that eBay was going to take its cut, and that was going to be the future because they had already monopolized it until they hadn't. And now eBay is one of those companies that has fallen by the wayside and has been a disappointment over the last quarter century, as
Yeah.
far as the. And it's funny because when I think, and if I try to let my memory serve, I could think of no other company that felt like it was ready to absolutely break through, quite like eBay felt to me in 97 and 98. And I don't know. I mean, you have to pick some of these companies out there. Who knows? I mean, how about the street's perception, going back to General Electric, what the street thought about Jack Welch 25 years ago? Same thing, right? That company could do no wrong until it fell by the wayside. So I think we're starting to kind of feel that now in things like the S&P 500 growth, where they are great. There are great business models dominating the S&P 500 growth. Great businesses, profitable businesses, good companies. You want to work for those companies. Maybe you want to work for them. I don't.
Yeah.
Maybe you
Yeah.
don't. But people want to work for them, and you just don't know if there's going to be somebody that comes around the corner and gets them, and they become this generation's eBay.
Yeah. Yeah. eBay to me at this point is so unusable. It's the worst
Yeah,
website. But who knows? You know, it's the difference between stock and a business too. I mean, you know, can't sell something on Craigslist either, which is why a lot of the modern platforms have taken a lot of wallet share.
yeah,
All right. So, you know, one of the things you talked about was sort of over the past, and we've seen this, and we'd be curious to hear where you think we are in this game, in this regime. But certainly the rates up, you know,
yeah.
if you go back to 2020, you could look at the pandemic bottom, you could look at rates bottoming or the election, whatever. But
Hmm.
since then, rates have been up. And you've had a very different regime with stocks. You know, you've had essentially a lot of the inflation exposed assets, but also value investments have
Hmm.
rebounded. Do you think this something that has legs? Is the story played out? Is it, where do we stand there?
Oh man. Okay. All right. So I think about this all day long. And with the market, you always have to be ready for when that thing that's driving the market stops being that thing.
Mhm.
And that thing has been interest rate directionality all year, right? Almost to the point where if you were out of the house all day, out of the office, and I bumped into you at the end of trading, and I said, "Meb, rates were up 10 bips on the 10-year T note in today's session," right? You say, "Oh, value beat growth." And then you'd open it up, and sure enough, 500 value beat 500 growth by 100 bips in that session, right? Um, and that's all that matters. And then the
Yeah.
market gets hooked on these things until one day the rationale for whatever is the winner or the new thing on the street morphs into something new, a new rationale. And I mean, just think about it. So it's been all these years where tech has been working, right? And so why might that be? Well, in 2011, it might be I need to be in the US. I need to be in disinflationary growth because I'm worried about those European stocks because of Grexit. And that's what you would do, right? You go piling in as a defensive trade into some of these groups. And then, oh, it's 2015, 2016, and China's going to slow down. And okay, so I need US dollars for that reason. And then next year it's some other reason why you're claiming you need US dollars. And it's just, well, just because you want to be bulled up on dollars. And that's what the market wants sometimes. And I think right now we'll have to see how long it goes on for. But right now, so long as the thesis is the thesis of the viewer is that rates will be rising from here, then value is on. And that's important because that is 180 degrees opposite of really one of the old notions that used to persist basically for my whole career, which was it used to be, well, if you think rates are going to go up, this what it used to be until finally after a dozen years of 14 years of growth clobbering value, people needed to change the thesis. The thesis was, all right, I think rates are going to go up, and I want to underweight utilities, REITs, staples, healthcare, divs, right? Uh, okay, and if I think rates are going to go up, I likewise want those other things like discretionary. Um, was the old theory, and the reason because rates rising means the economy is entering some sort of expansion, right? And if they're going to have some expansion, that's why rates are rising. You don't want utilities. You want like some restaurant stock. But rates are rising now for a different reason, Beb. And those rates are rising now because we just spent 2 years running budget deficits in this country akin to what we did in the Second World War. Uh, and I don't know. I mean, it may be as simple as rates are rising because the captive buyer with its $9 trillion balance sheet is no longer a captive buyer and it's backing it up. And now the market has developed a new story. And this is important because why? Where did this store? Why is this sudden discounting of future cash flows on unprofitable growth suddenly become the number one topic of polite Wall Street conversation? I get it. This is like business school 101, discounting future cash flows, but suddenly it has taken the mantle. And it goes something like this. If rates are going to rise, then I don't want some company who's promising me cash flows in the year 2030 because the net present value of those cash flows is going to be notably hindered, much more so than my local gas utility or toothpaste company,
Yeah.
essentially is the argument. So now the market does what the market does, which is it has found its reason to like value. There's no right or wrong, Mab. It's just that's what the market wants to do, and it
Yeah.
likes value now.
And, it's funny trying to track or figure out like what the sentiment shift
Mm-hmm.
has been. Cause like, we were doing tweets over the last handful of years But we had one where like really at the peak of the value spread, do you use value, growth, or market cap weighting? And most people still didn't use value. And I said, well, if you're ever
Yeah.
going to use it, it would have been now. But then fast forward, once value does well for a couple of years, that's when people probably want it.
You wonder, did value just get too popular by the mid 1990s, right? That we had already known well the name Warren Buffett by that time. And if you look at the cycles that we've witnessed, I mean, you could be a very, very seasoned veteran in this industry. And what would you have witnessed? If you came into the business in 95, you witnessed a 5-year growth cycle, 95 to 2000, then value only from your years of 2000 to 2006 or 2007, depending on which index you're looking at, and then growth ever since, aside from the last 6 or 12 months. So somebody who came in 95 at age 22 was born in 73, so they're 49 years old. That is a 49-year-old who has been on the street and has only ever seen 7 years of value. And critically, because we are humans, they forgot because it's been so long. It's been so long since value was working. I mean, and what did value need to work last time? It needed a secular bull run in oil, right? From the 1998 lows, which is, well, value took hold in March of 2000, but, oil was down in single digits and ran all the way up to 147, right? That was a cycle that it was time to exit the US dollar. It was time to get long things like emerging markets at the turn of the century. That's another one. Emerging's been down and out. And I'll tell you this, what's fascinating, you look at this market, the pain points in this market, it's EM value that has been holding up, in that its order of decline has been so much smaller than the previous darling, the NASDAQ. I mean, I mean, I have to back of the envelope this, but it's probably 2,000 basis points worth of differential year to date, or from the NASDAQ peak, between the NASDAQ and something like MSCI EM value. And so now the market almost has a new sense of what is a haven, right?
Yeah.
If it is going to be these central banks doing battle against, they missed it. They missed the inflation. Now they're going to be battling for a few years. If that's what it is, then that's why we've been seeing this. I can't even. It's fascinating to watch a bear market, if that's what this is, in which EM value is actually like the portfolio saver on a relative basis. It's a mind change. People that aren't on it, they sticking with that. I oftentimes say the 2009 to 2021 playbook. I think they're in for a rude awakening if they don't get on what the market now wants.
Yeah. And the crazy thing is, if you look at the EM value, and this includes an entire country going to zero,
Right.
has outperformed, like you mentioned, NASDAQ significantly, and is actually, since really beginning of the year, in line with the S&P, which is crazy. But yeah, you mentioned, I mean, you had that decade of 2000, EM just absolutely destroyed S&P, and then the vice versa in the last decade. I have certain tweets that are extremely unpopular, and then others that are only mildly unpopular, never just popular, sadly. But the anything emerging market related is really unpopular. And I did one
Isn't
today.
that the truth?
I did one today where I said, I mean, China's got to be up there with, sentiment, super negative. But I said the valuation Chinese stocks are at today is as low as it was in, let me get the dates right real quick. It's at a CAPE ratio of like 11 or 10. I said it's as low as it was in 2005 and 2016, both of which preceded a massive run, 50 to 200% up. And then I had a Clint Eastwood gift, said, do you feel lucky? Because a lot of people see this Russia scenario play out and they say, man, this is a potential stranded asset. What is the premium I need to accept for that? And I think that is in a lot of people's front and center. So, but EM, man, that's been
it flops for me too. Yeah, when it comes to Twitter content, WisdomTree, we have. I'll tell you the other one that like gets no action on Twitter is like a bull case on Japanese equities. You might as
Yeah.
well just not even bother tweeting. Nobody. It's been so many years since certainly since American asset allocators, which is who I'm mostly dealing with in business, right? I mean, it's like we're a U.S. based asset manager. Um, have you even given any consideration to Japan? And you know, it's funny when you look at an index like the MSCI All Country World, where let me forgive me if I'm off by a percentage point or two, but the
Mm.
United States is 61% of the all country world. And then there's just this massive drop off to number 2 and number 3. And that's
It's
China and Japan.
right.
Yeah.
It's over a 10x, I think.
Yeah. Japan. Okay. So think about the economy sizes, right? Japan is the third largest economy. And it is either number 2 or number 3 in the global equity basket, and it's 4%. So it's 15-fold weighting between the US and Japan. And there's bull cases in Japan, but nobody wants to hear it because they just, I don't know whether
I
people
think it's
are
even
doing.
worse than being angry, because being angry at least elicits an emotion. It's people just don't care,
That's
right?
what it is.
It's like they're just like Japan. Ugh, that hasn't gone anywhere for 3 decades. But as you mentioned, like I think we talked about this with your fellow coworker and friend Jeremy Schwartz when
Right.
we were talking about Japan and Jesper Cole and
Mm-hmm.
the composition of what Japan, the stocks and businesses has changed a lot in the last 10, 20, 30 years, certainly.
Mm-hmm.
And the cultural mindset at a lot of the companies has changed too.
Yeah. And look, Japan has its issues, right? I mean, it's been a constant struggle to get that cash off the balance sheet. There's cross shareholdings. Um, uh, the shareholder governance has been the recurring issue. And the bull case is that it gets cleaned up, start boosting these return on equity numbers, and pay out these greater dividends. And it's at the point now where Japan has a 2 handle on its dividend yield, which is much better than the 1.4 you can get on the S&P, or maybe it's one. Well, by now it's probably 1.5.
Yeah, it's going
On the
up. It
S&P.
almost
Woo-hoo!
we got darn close to the all-time record. This is another unpopular tweet where I think the all-time record is like 1 or 1.1 on the US. And
Yeah.
we got darn close when we were at the US peak, and now it's come up a little bit. But that was really unpopular tweet where I said, not even opinion. I think I just said we're closing in on the all-time low in the dividend yield. Man, people don't want the party to end, that's for sure.
Well, I'll tell you, when you start talking about yields and asset values, and you're thinking about tail risks or things that could come up and put a cloud over this market. I mean, the Japanese don't have the property bubble like we do, right? So I mean,
Yeah.
just picture the major metros in this country. It doesn't matter if you're talking about a sunshine state or a snow state. Like if you're in Boston or you're in Seattle or you're in Miami or San Diego. I mean, that's just the 4 corners of the United States right there. Boston, Seattle, San Diego, and Miami, or anything in between. It's a legendary bubble. Ask
Yeah.
and we both, you and I both know people that live in all those cities. We know multiple people in all those cities where home prices are so high. So what about a situation in which the, the U.S. stock market has to contend with this thing also going on, home prices coming down, theoretically, and then you have that country over there on the other side of the Pacific Ocean not dealing with it because they haven't had any speculation since 1989. There's also that type of concept. And I'll tell you, I don't know why the street isn't more concerned with housing. Every indicator in housing is rolling over, aside from only early indications on inventory, right? I mean, it is still, your 20-person open houses only has a dozen. It's not exactly bearish, right?
Yeah. I mean, you and I joked before the podcast started. If you're watching this on video, I look half homeless, have like a Rip Van Winkle beard because I think I manage, we'll see, to personally top tick buying a house. And then, of course, the worst time in 2 decades to renovate a house. So I'm a great contrary indicator on the timing of some of these personal finance life decisions. So, but it's funny because there's been one of our very first podcast guests, and I think it's darn near 5 years ago. One of their thesis was talking about Canada real estate bubble and how to play, shorting that. And then 4 years later, here we are. It's only gotten crazier to the point where Canada was proposed legislation, or I think enacted it, about not letting foreigners buy certain real estate. And so Australia and Canada is kind of like a well-known craziness, but like these things can last a lot longer than we think, and then eventually when they turn, but it certainly feels like a turn in a lot of these investments and idea, at least anecdotally, as well as some of the data as well. But I have personally a lot of experience with friends just being totally priced out of the market and all the craziness going along with 40, like you said, 40 bids as well.
Well, and I don't know if you know this about me, but I was working for many years with the Canadians, because I was with BMO, Bank of Montreal, and then
what's your origin story? I want to hear it. I don't know the full background. You were
sure
trading stocks in third grade, then what?
Trading stocks in third grade.
Shorting stocks, even better. Not trading stocks, shorting stocks. I can see the teachers being like, I don't even, what is this kid talking about? What
is this guy doing? I don't even know if I necessarily knew what I was doing. I remember I was short Biogen and Centocor. Do you remember Centocor?
No, but I remember Biogen, and that's my number one PTSD stock. So we're gonna have to move on from Biogen.
Okay. I thought Lucent was.
That's a top 5, but
okay.
But Biogen's number 1. It's not even close.
Well, I had some South African gold miners about 20 years ago, and I watched the gold price go up while the gold miners in South Africa just died on the vine. So I've had some of those in my time as well.
Believe me, all my mining friends are moaning endlessly about what in the world is going on with metals and mining. They've been a big laggard. I think that has been a surprise to a lot of hopeful mining investors that see the inflation and turmoil, and historically that's been pretty good for the shiny metals.
Well, we were doing a call earlier today, and we were talking about what's actually working in this market. And you just think about a petro state like Brazil, right? And of course, Brazilian real is rallying. Yeah. This is in a dollar strength. This is like the centrism of a developed world. We talk about the dollar rallying because we put it in context of the euro and the yen, right?
Right.
But the dollar is not rallying against the Brazilian real. It's not rallying against the ruble, both, again, oil, right? Yeah. And the South African rand, like thinking about that, which is metals and mining, is roughly flat, which is a moral victory in a year like this, right? In a risk-off year, the South African rand. And, I was looking at some of the data, and you look at some of the countries that in the past have had some run-ins with inflation, where it was debilitating, right? I mean, you had to create the Brazilian real in what was that, 1993? Was it 1999? I'm not quite sure. They had to create the Brazilian real because Brazil had hyperinflation. And you roll into 2022, and guess whose central bank is actually saying, we have inflation, we need to hike rates, as opposed to our hubristic Federal Reserve that says we have inflation. To sit there, now you got me riled up, to sit there and watch that guy, Roaring Kitty, bid up all these meme stocks, put this guy on the front page of the Wall Street Journal. And I think, Meb, help me here. When I Googled meme stock to try to find my earliest reference to that phraseology, I want to say that was October of 20. And they kept zero interest rate policy on that.
I cannot hear the word meme in the whole meme stock thing, where they were doing an interview with Bryce Harper, the baseball player, and you shouldn't make fun of people who learn words from reading or whatever, but he pronounced it meme. And people were just like, what did he do? Like a video interview. And like, did he just does he mean meme? But he's like, May. And I was like, I can't hear it any other way since then. Oh, well, we can
Yes.
post the video to the show note links, but it'll give you a good chuckle. So the May stocks. Yeah.
Well, there's a bunch of those. Like Christine Lagarde. I only had ever heard back when she at the IMF before at the ECB, and you'd see it, and I don't know if it's Lagarde or Lagarde. I'm guessing Lagarde because nobody ever mentions this person to me until she went over to the ECB, and something else I never know. Usually global leaders are the things you don't know how to necessarily pronounce because you're not talking about obscure prime ministers or presidents of some tiny country. But yeah, a meme stock.
May.
But yeah, they kept zero interest rate policy on the balance sheet, the $9 trillion Federal Reserve balance sheet, which was okay, what, 700 or 800 billion before Lehman, right? So it's multiplied 11 or 12 or 13 fold. That was still expanding as of April 15th. That's when it peaked, and I think today is the day that's first officially where they officially start doing something about the balance sheet. Recording this here in early June. I know we'll probably go on the air in a couple weeks. I just don't know how you could sit there and watch the NASDAQ run like this. How you can sit there and watch. And I know there's a housing shortage, but everything that we just watched as a society happen in the housing markets down in Dallas and Austin and Orlando and San Diego. I mean, come on. How did you not hike rates before this? Now you got a real problem on your hands because the 25-year-old newlywed couple with a baby can't get a house to save their life. They're in real trouble. And a 45-year-old couple can't afford it. I mean, a 65-year-old couple, it doesn't matter. These home prices have become completely unaffordable. It's a whole other reason. It's Alan Greenspan's fault, but I don't know if we want to go down that rabbit hole.
I've for a long time kind of joke half seriously. I was like, the Fed could easily just quantitatively just peg the Fed funds to the 2-year, which is what it usually does over time with a lag. Obviously, they're not going to say they're doing that because then they are now saying they do that. But I always laugh about, I'm like, why? You pull up those charts and it's like a near mirror image, but clearly inflation and the 2-year, there's a pretty historic spread. I mean, one of the things you talked about, if we look forward, the hard part for investors is you have these two pretty binary outcomes, right? We not too long ago on this podcast, we were talking about would the 10-year go negative on yield, and that's a very different environment for a portfolio than one where a potential 10-year of 3, 5, 7. You at least have to put both sort of considerations in your head as we look forward. I know you had some good charts about the 70s. 70s were really tough for investors. Really not much helped other than real asset exposure. So what's working this year, but also value stocks ended up doing okay. One of your good charts that shows that. As we look to the horizon, like as we think about equities, what are we thinking?
Yeah,
give us. I'm getting. You have to have a crystal ball, but like as we look to the horizon, you've been really right for the last year, which means you're probably setting up to be really wrong for the rest of the But I do want to give you credit because usually when you're right about something, it's crickets too. Like you say it and then like nobody cares, and then you were definitely one of the people that were on this trend. Cliff Asness certainly has been banging the drum for this environment, but what about now? I feel like it's a little harder, or is it easy? Talk to me.
Well, and you have to be okay. So you have I
mean, it's always important to be humble in our world.
That's exactly.
That's like to me that's like the number one. There's so many examples like to a day or a minute where people do something that's so embarrassingly like bad, and I'm thinking to a particular growth manager that put out a video dunking on basic passive indexes and old economy value, and it was like to the like month, like the top tip.
Ugh.
So anyway, humility is a lesson we all learn because we all get taken to the woodshed at some point. So
Oh, completely,
yeah,
completely. And yeah, you do always need to remember that sometimes you just get lucky and you attribute it to your own genius. And you get some trades right, or you make a call and you think you got something right, and you start saying, these people are real morons. I'm the one who's got it together. And the next thing you know, you get it across the
yeah,
face.
yeah.
And look, I mean, I'm at WisdomTree, dividends, sitting there watching Facebook rip higher all those years, and Netflix. You want some humble pie, right? Meb, I had my wife for Christmas one year when we were dating. Okay, this is like 20 years ago. We met when we were 18 and 19. We started dating. She gave me Graham and Dodd for Christmas. Okay, so this is like Christmas of '01. In retrospect, reading Graham and Dodd was probably the worst financial decision I ever made, because the last 20 years I've been in value. And I'm a value it. There's nothing.
The tortoise is okay, man. The tortoise, it's you got to deal with you just don't get it comments on
right.
occasion, but eventually you get to the finish line. That's the nice thing about value usually. I mean, you get
Yeah.
the occasional 08s where value also gets pummeled, but over time, like the Mr. Market of value versus the alternative is a little less psychotic. Robico just put out some research going back to the 1880s,
Okay.
with value type of strategies, little multi-factor. I think it even had some momentum sprinkled in, but compared to the alternative, and it beat essentially in every decade, going back over time. But for me, the alternative is what's worse. Like it's the unprofitable, expensive, poor momentum stocks. Like, my God, what a nightmare. but occasionally they rip your face off. So that's the way it has to be.
Well, and you think about when do you get contacted by your friend? They got something they want to tell you about, like a hot new cannabis thing, something like that, or this company's going to come up with the next Alzheimer's breakthrough, and some of those hit, and many of those don't. And nobody ever says, "Hey, let me tell you about this great company that's making drywall." It's just 6 or 7 times earnings. There's some of that. There's an impatience that people have, and value investing is all about owning those types of companies that are not really, you don't walk into a cocktail party and brag about them. You're buying them because it's a stable business. You're trying to find consistency with earnings, right? That there's not something that's going to come up and knock the company for a loop. And
I would say the emotional reaction I have for the vast majority of investments in a lot of our portfolios is kind of like disappointment and disgust. I'm like, man, we own that. Like, are you joking me? And full disclosure, listeners, the number one holding and our oldest shareholder yield strategy is Dillard's. I'm like, I haven't been to a Dillard's since the 90s, like as a Southern department store. Are you kidding me? We own that? Oh God, that's and that often is the case. But that's the beauty of being a quant, ladies and gentlemen, is you don't have to have the emotional attachment. In fact, you don't even have to know what's in the portfolio. You just have to let the computers guide you. So,
well, I'll tell you, shareholder yield. I mean, how you've seen my stuff on that, and it's interesting because there's a part of me thinks that is where the industry may go in terms of classically, oh, I'm an income investor, give me dividends. I think it could at least achieve a chunk of that business industry wide, shareholder yield being the sum of the dividend yield plus the buyback yield. right? I know you play there. We play over there at WisdomTree as well. And I don't know that buyback yield gets the attention it deserves because it's kind of a calculation people don't really know. It's kind of really only took hold in the last 3 or 4 decades, and so you don't have the 100-year histories. Like, you could pull up 100-year data on S&P 500 dividends and have at it, right? You can't really do that on buybacks. But I'll tell you, a buyback program intuitively will keep a wild manager, a wild CEO in check, right? Like, I know that you've committed that you're going to buy X billion dollars worth of shares back from us over the next 12 to 24 months. I don't think you're going to make some foolish acquisition because you won't have the capital to do it. And the stock market's riddled with stories of foolish acquisitions. Oftentimes, those acquisitions are made right during the good times, right? Like, is it Ben Graham? Maybe it is Graham. I read enough Graham and Dodd. Maybe it is him where he says, so what is it that he says? Something like the greatest losses in the market were people buying inferior assets in the good times, something like that. And that's what happens oftentimes is like, I got a few $1 billion in cash sitting on this balance sheet. Let me go acquire somebody. And the year is 1999.
Yeah.
Yeah.
Well, I like the opposite is equally as important in my mind. The buybacks are all well and good, but it's also that you're avoiding the serial diluters. So the companies, and tech is super guilty of this, but are just issuing new shares hand over fist all the time and diluting you, whether it's management or employees or just raising capital, whatever it may be. So you kind of get both sides. I mean, the value part of that discussion, I think, is simple. Like, everyone gets buying something cheap, but it's also you're avoiding the expensive, right? And so avoiding the past year, avoiding stocks trading above 50 times price to sales or 100
Right.
would have helped you, not just that you're investing in the cheap. And so I think both of those are equally as important, to think about over time on selecting investments.
Well, the thing about the share dilute, I love that you brought that up. It's this concept that I oftentimes bat around, which is maybe it's not so much what I make sure that I do own, but what I make sure that I don't own. Right? I mean, the old stuff where you have $100 worth of capital, right? You endure a nasty bear market like 1973, 74. So you're down to 50 cents on the dollar. And then now what? Now you're psychologically beaten down and you're supposed to stay long stock market, even though you just lost half of your capital. And then it takes you a while to get back to even because you got wiped. And if you think about the profile, I mean, not every company is the same, but just think about the type of company that needs to either A, raise capital via debt, a bank loan, or the debt markets, relative to one that needs to raise capital via the equity market. And think about it like the old metals and mining. All right, so we got a 20-cent Nevada gold miner on the pink sheets, right? And it's time, this gold mine's going to be great. And it's time to raise capital. The debt markets aren't going to give that. You must dilute the shareholders. There's no bank loan coming, right? It's an equity issuance. That's how the pink sheets type companies raise capital. And it's because it's an unsavory, highly risky venture. In sharp contrast to, I don't know, Procter and Gamble or PepsiCo comes into the marketplace. I don't know. I assume those are AA or single A credits, something like that. And a company that will still be functioning tomorrow raises debt capital. And so when it goes back to the shareholder yield or what you're doing with buyback programs or diluting, even inside something like the S&P 500, which is generally 500 very nice companies.
Yeah.
The 100 or so that are doing the least in terms of buying back shares, or the small proportion of them that are diluting, are usually the landmines. There's something wrong with the business model, because for every one that is diluting because they legitimately have a great project, somebody else is diluting because it's hitting the fan over there at headquarters. And so you just got to be careful with that stuff. That's why I think shareholder yield could be an interesting one. I mean, I certainly look at buybacks when we're looking at fundamentals across funds, or where we're trying to win new business, that type of thing across the fund families. I think it resonates.
We did a recent study with some friends that was shareholder yield on all the sectors and industries, and it's actually surprising to me that it worked in all of them. I mean, I figured it would work in most, but it worked. And the
Mm.
miners was the inspiration, right? I was like,
Oh,
more than
okay.
anything, just like more than anything, this sector is just a dumpster fire for capital incineration, right? Anyway, but so one of the things. Okay, so who knows how long this bear market will last? I'm calling it a bear
Mm,
market. We were down around 20. Now we're down less, but maybe that was the end, or maybe it goes down 40, 60, 80. Who knows? But you
hmm
had a post that I thought was thoughtful, where you were basically like, look, and had everyone's favorite fraudster, Madoff, on there, and you were kind of
Right.
saying
Okay.
like,
Yeah.
what do we start to see when there's a bear market low? Because people always want to pick the bottom, right? But
Right.
that's of course hard. But what are some signs? You said there was three big ones that we could keep an eye out for.
Well, there's several, and it's some of it's the feel of these things, because one of the things I said is you got to identify a Ponzi scheme. There needs to be a Ponzi exposed, and that Ponzi gets exposed in the seventh, eighth, ninth inning of a bear market, whatever that Ponzi may be.
And
Um,
in some cases, there's multiple. I wonder if the Bill Huang,
yeah,
it's not really a Ponzi. He just had like insane leverage, but that's certainly one that, the same sort of
right.
thing, like all the levered players that were exposed to one environment. I mean, you see Tigers down a ton this year, et
hmm
cetera, et cetera. Obviously, ARK being the poster child of this one. But Huang being I mean, what was his peak AUM? I mean, he was, I can
And
look
that
this up.
and that was and that was like a spring of 2021 headline. So
Yeah,
that one's been
that
out.
was early. Yeah.
Greensill. Um, I'll tell you. Well, there's several things, and this is so fun. I love this business. Another thing that, and this is a little correlated to what you said, and I do think it's important to talk about the things that get exposed at the end of a bear market. But another thing that was a little bit of a, well, not in retrospect, it was a big warning, was the SPAC implosion,
Yeah.
special purpose acquisition company. And, there was a time there where the SPACs have a net asset value of $10. They were just melting up. It was a big boom. Against, these are blank check companies. They are, not exactly, um, for retirees, let's say. And now that has completely busted up. There's a bunch of them out there under the $10 NAV, 990, 980, and that they've now completely deflated that bubble. That in terms of speculations, unwinding, I think that, to me, the meme stock thing was so outlandish. That was worse than .com, because at least with .com, the investors thought that there was a future of these companies. This was a joke.
Yeah.
But then somebody said, "Well, is the Luna and the Terra thing? Is that maybe that was that thing that happens near the end, and it's time for calling a bottom?" And I don't know. Maybe that person was right. This is a person on Twitter. It's like, "Well, Jeff, what about that?" It's like, well, those are things that were, the classic bear market where regular people walk into a situation and lose their life savings. Those are the types of headlines you see towards the end of a bear market. That happened with Luna and Terra. And I'm not seeing that article about the retired couple that they quit their jobs to day trade and they put it all in the Nasdaq. I haven't seen that one yet. Another thing, and I mean, this all presupposes that you're at a legendary bear market too, like 1973, 74, like 2000 to 2002, like '07 to '09 Lehman. How do you claw out a bottom? And what I was saying in that was, there's several things. One is, you'll usually, towards the end of it, you'll get the government will come in to do something, right? The government's going to help.
Yeah.
And the one I cited was Jerry Ford coming in with the employee retirement, ERISA, which is kind of like a pension protection, and that's like ring the bell on the market low, because I think that was in the autumn or winter of '74. It's like time to get long stocks. You do see several kinds of crime get exposed towards the end of a bear.
The accounting and embezzlement. So you listed three. You said Ponzi scheme, accounting scandals, and embezzlement. You said ideally you'll have full signal once you witness all three, but 2 out of 3 should suffice. And certainly in the crypto space, you're seeing some of the 2 and 3. I mean, that's kind of been par for the course, but there's but full on sort of like embezzlement, accounting, large scale. It doesn't feel like that's fully come to the forefront yet, has it?
No, it hasn't. And then we have, the market's never going to be easy. It's so tough. The other thing is remember that to the extent that we've had headlines in which people have taken total losses or there's been corruption, it has been in this completely different asset class, crypto, which is interrelated and intertwined, but and we clearly don't have crypto in 1932, where you're getting a bear market bottom from 1929. We don't have crypto during the Gerald Ford administration, right? There's no other thing that's happening on the side of that which we're trying to figure out, which is the end of a bear market in stocks. Because most people don't have Ethereum or Bitcoin still, right? So there needs to be, if it's truly one of those three, like 1973, 74, something like that, you probably want to see something like another Bernie Madoff get exposed in classic equity only fund management. Corporate accounting scandals are usually a pretty good sign that we've washed out all of the wishful thinking of a go-go era, certainly WorldCom, Enron. You also want, and this is the most difficult of all, you have to be gauging the sentiment of non-Wall Street people, which is really hard, right? So, I mean, it's like Meb and I are sitting around, we're talking about the market. Meb's like really bearish, let's say. But Meb might be really bearish because he's looking at quant all day. He's looking at 100 charts a day. So Meb is not my contrary indicator. My contrary indicator is like my brother or my sister who's sending me a text, right? So this will happen where, it's like, hey, Jeff, should I be in stocks anymore? Like, should I just be in all cash? Says like the kid who sat 4 seats away from you in 6th grade English class. Like, where's this guy been? I haven't talked to this guy in 15 years. That type of stuff. Like, there's none of that.
The weird part about this cycle, and there was the AAI is usually okay, and they had some really low readings end of April. It's since bounced from then, so it's sort of a contrary indicator. That's actually was pretty money. We'll see how long it lasts, right? We haven't had much of a bounce, but the weird thing about, there's 2 parts to the sentiment, is that one is that stocks and bonds have been getting hammered this year. So that is one that's probably a little unusual for most traditional investors, because they assume and expect bonds to hedge stocks. We're one of the worst years to start for 60-40. But also, if you contrast what they say, so the bullish sentiment surveys versus what they do, which is the percent stock allocation, which is near an all-time high, and usually that just drifts with price, there's a huge disconnect. And that to me is like, hey, we've had this giant run, Tina, there is no alternative. Most of the general populace is like, I don't know what else to do. It feels like to me, like, so they're they're nervous about their holdings, but they're not sure where else to go because bond yields are so low. This is like a poster child for a lot of our services, but
Right.
I don't want it to be a commercial, but I feel like that's the vibe. If I had to put a thumb on it, I don't know.
Yeah, it's tough, and I think all right, say the bear market ends right this minute, and it is a bear. We reached, I mean, NASDAQ was down 30 some odd percent. It's hundreds of names down 60, 70, 80%. That's a bear market. All right, where does it end? Well, nobody knows. I don't know, and you don't know. I mean, I can conjecture a guess. I think that we might still have some time left in it because, again, I don't think that the stock market is fully appreciating the existential risk to home prices here, or the labor market, which I imagine we'll have a four handle on unemployment pretty soon, which nobody's calling for. Okay, bear market ends tomorrow, or it ends a year from now, or 2 years from now. Who knows? What I think is important to note is that what we have seen here from a societal basis, I think the COVID lockdown and reopening is just that kind of massive change in the order that you sometimes need to have regime change, right? Like from generation to generation, something changes in society. That might have been it. Right before that, it might have been like September 11th, just like a massive event that shook your world that you remember vividly 20 years later. I think maybe September 11th and COVID are those two things, right? Okay, and so now what has happened is the market has stopped rewarding the stuff from the prior era. We've washed our hands of that era. That is now over, and it's a new regime. Whether that's
It's hard, which is hard for people because they always want to fight like the last battle. It's like
yeah,
it's hard to adjust. This one is particularly hard because a lot of the investments were so absolutely destroyed that are doing well this year. The energy, ag, resources, the whole complex has been just decimated.
just like 2000 onwards. Remember when everybody was putting MLPs in their portfolios? Like that's
Oh
going to be
gosh, that's right. That was a big.
that was like the thing when we were doing asset allocation. Beginning of my career, it was like equities and bonds, and now we need to put some alts. And so that was when a lot of this is in private client. A lot of the industry was starting to do, let's flirt with managed futures, and let's put high yield in these portfolios. And these exposures we have to EM equities are too low, and MLPs. We'd have people coming in talking about MLP. A lot of products came out in the ETF business for MLPs. There was ETNs, exchange traded notes on MLPs, and then you actually had MLP ownership. I mean, it's just the cycle. It was time for the cycle to change, and it became a pipeline and energy and emerging market cycle. It was a dollar bear market, and it was a tech bear. Like you said, I don't know, maybe an hour ago, Microsoft was dead money for so long. I could picture that chart. All right, so the bear market ends tomorrow, or it ends 2 years from now. We have new leaders in this market. Those new leaders are value sectors. And the laggards are notable for being the ones that are so overwhelmingly populating growth indexes. The S&P 500 growth is it was 61% tech plus discretionary. What are the two worst pain points this whole year? When you come out of this in a new bull market that starts a day from now or 2 years from now, the new leaders are not tech and discretionary. Now, they can catch bids on a bear market rally or relief rallies, or they might catch windows of time, just like in the last 14 years, value had some 6 and 12-month windows where it was kicking butt. But generally, 07 to 21 was all growth. I suspect that we're coming into something like that. I think we've had a massive change in mindset. And I also think that we might have already reached that point here where there was a critical mass of people that have gotten so burned in speculative assets, whatever that may be, COVID vaccine companies like Moderna, maybe something like that, or unprofitable tech like classic Russell 2000 growth spec stuff, that they're not looking to get long those names anymore. it's like these people that were day trading back in 98, 99, like they missed that whole bull market coming out of that. And that's the thing, is you got to make sure, you got to know your own mind. You got to know what kind of loss you can take to keep playing this stuff. It's one thing to say we're going to hold stocks forever, and that's the objective. But then that person that sells the bottom because they could take a 20% loss, or they could take a 30. They don't actually know themselves. They could take a 40, but they took a 50 or a 60, and now they're out for good. And now they're sitting in cash when some bull market commences. It's
Yeah.
tough. It's tough.
So as we look out to the horizon, what else are you thinking about? Are you excited about? Are you confused about? Are you scared about? Any of these emotions? What's on your brain as the summertime Chi-town vibes rain down on you? What else are you thinking about?
Well, I'll give you some ideas. You tell me where you want to go with it, Meb.
Great.
I think there's a fighting chance the US birth rate could end up surprising to the upside.
Ooh.
Um, yeah, yeah. I don't know if I'm sure about it, but I at least think it's got a shot, which is
That's
greater than this.
that's just personal experience. Why do you estimate that?
Okay, for one, remember, in order to have an upside surprise, all you have to do is exceed the consensus. You don't have to be a hero,
Hmm.
right? Like XYZ Corp the street sees 22 cents of earnings at the earnings report. I only need it to be 23 cents for me to be an upside surprise. I don't need to
Yeah.
be a hero and say it's going to be 50 cents. Well, there isn't a demographer that I know of that is sitting here and looking at the Jessica and Jeff Weniger experience of working from home and saying, oh, maybe these people might have more kids than they would have had in 2019. I can't begin to tell you, among the laptop class, what this has done to our work-life balance. I'm in my house right now. Everything that you make as a decision is based on the costs and benefits. Think of having an infant or a toddler or an 18-year-old. It's tough, right? And we don't know. We ended up with a number of kids in this household, and I think that it has been notably easier to have. In this case, we have 4 kids than it was to have one kid when I had to go down there on the train every day down to BMO years ago in a classic office job with, scramble and trying to get on the red line, which is our train here in Chicago, trying to get on the brown line to make all of this work. Whereas instead it's like, it's kind of easy. It's kind of
Yeah.
easy. Like we have, what did she say? We got a kindergarten graduation on Friday. I will be able to attend that. Why? Because my employer, WisdomTree, knows that I'll get my stuff done if I'm out of here on a Friday morning from 9 to 10 a.m. It's cool because I'm making up for it on Saturday and Sunday, right? So
Yeah.
that is a notable thing. And the other thing is at some point do you get to um, a bottom where we've always said that it has been the increasing wealth causes the birth rates to fall, as we've seen throughout all societies. But is it that we just reach a point where um, it no longer is that driver, and it's much more along the lines of the logistics of actually managing this extra job in the household, the diapers and the bedtimes and all of those things. And I'll say this one final thing. For me, the most difficult thing for me when these various children were in an infant stage was functioning during business hours in a physical be there and attend the office setting when I didn't reach any REM sleep the prior night, like trying to function as total zombie. And the PMI leads this by 6 months, and therefore it's like trying to get all that stuff together. In contrast to the complete elimination of the commute for tens of millions of these people alone, changes the productivity and I guess you could say the degree of misery when you are sleep deprived. I think it's
Yeah.
a game changer. So I think it's going to go moon shooting. I don't know, but I think that we should not necessarily say it will permanently stay low. It is inflationary. It is bullish over these 20, 25-year timeframes. It would be the opposite of the deflationary case in point being, Japan with its 1.3 babies per woman birth rate.
Well, that's an optimistic way to start to button down the end of this conversation, Jeff.
Was it BS? Wait, was it BS?
No, I mean,
I've
heard both sides of it. The depopulation and is a big risk, but I mean, come on, humans, they just need to procreate a little more. No one can be against that. What's been your most memorable investment over the years, other than your third grade biotech short? What comes to mind? Good, bad, in between.
That's probably the most memorable. The ones you remember the most are the ones you get burnt on. And what's the old thing where the psychological pain of a loss is twice as brutal as the victory of gain, or the benefit of the gain.
Mm-hmm.
I mean, I really I remember it was like 20 years ago, I nailed that gold bull market and I didn't make a dime. I had a bunch of individual names down South Africa, as I was pointing out there. I had Durban Rudaport Deep, which is now I think DRD Gold, and I had Harmony, and pull up the charts of those things from 20 years ago, right around the turn of the century. And I was like a gold bug back then. I really thought the dollar was in for tough time, and it was. And that's a good example. And I've heard people through the years say, like, I nailed the thesis and I didn't make a dime. Right? Like there's been, look at China.
Yeah.
China's going to come on and become a world power. It's going to be the number 1 or number 2 economy. You'll see. But if you invested in China in the last 20 years, you didn't make as much money as if you just bought the S&P. So you nailed the thesis and you got it wrong at the same time. So, hey, the markets aren't easy, Meb.
Yeah, no, the timing is tough. People want to follow you, your great charts. What's the best spot? Twitter, work, elsewhere? Where do they go?
Yeah, I'm on Twitter. It's Jeff Weniger. If you can ever spell that, it's WENIGER. I don't know if it appears on the screen. We're writing blogs over at WisdomTree, and then longer form pieces of the market insights. I got one coming out. When are we going to publish that? It's a little grisly on housing. It's kind of cool. That's one of the great things about WisdomTree is they let us talk about things that are topical, that are not just pushing ETFs on people, right? Just talking markets. And then I'm going to start doing some content on LinkedIn. I think I'm going to tie the LinkedIn in with the Twitter. Maybe I'll ask you, since you're like a social media guru, whether you think that's a good idea. But yeah, the blogs, market insights, and Twitter, and that's its value, its dividends, its macro, all that stuff.
We'll put a show note link on mebfaber.com/podcast listeners for all those links as well. Jeff, this has been a tour. Thanks so much for joining us today.
Awesome, Meb. Till next time, I guess.